If you look across our ASEAN region, a lot of the major ASEAN banks, they are well capitalized, but they are having a very costly capital structure. When we look into the banking terms, it's what we commonly coin as the common equity tier 1 capital. And they rely heavily on that to actually meet capital requirements. That is actually costly.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today we have an important topic. It's a talk of the town. By the time you hear this episode, probably the town stopped talking about it already. But it's fine. We can be third-hand news as long as we are good, right? So we want to talk a little bit about the Fed adjustments. But beyond that, how does it affect the overall markets? How does it kind of affect other tools and investment products? Be the fundamental discussion of today, right? So I'm joined with two astute guests, right? I think you are very senior in the industry and reputable people. So maybe introduce yourself for our audience that don't know you.
Thanks for having me. So I'm Rena Kwok, credit analyst in Bloomberg Intelligence, covering mainly ASEAN, Indian, and South Korean financials. So just a bit of Bloomberg Intelligence for those who might not have heard about us.
I was about to ask,
yes,
what does Bloomberg Intelligence do?
So I think that's a good question. So Bloomberg Intelligence, we are an independent research arm within Bloomberg, where we actually cover investment research across equity, credit where I'm from, ESG, and strategy. We're probably much like a full suite research house within Bloomberg.
Wow. Okay. How are you independent within Bloomberg then?
Pretty independent. That's why.
Because Bloomberg is huge, right?
Yes,
it's so many things, right?
Agree. And I like that because like what you mentioned, Bloomberg is huge because of our broad ecosystem. We could actually use our insights not only to help the external clients, probably the speaker beside me as well, but really we have our insights to add to our sales colleagues, to our news folks, even external media. So which is why I'm here today as well.
Yeah, it's true. I mean, I remember in school when we first played around with the terminal, that was I was like, what? So that Bloomberg is big in the market. So thank you for spending time with us. And Tony, you want to introduce yourself for our audience that don't know you?
Yeah. Hi, everyone. My name's Tony Raza. I work at UOB Asset Management. I manage multi-asset funds, and multi-asset funds require us, therefore, to look at a broad set of things that are going on in the world, because we'll invest in stocks and bonds and commodities, and we'll invest around the world. Therefore, key topics around the world like interest rates, we're always interested in. Like any piece of news on any given day, if Israel is attacking a country, I immediately start to think, how does this affect stocks? How does it affect bonds? How is it going to affect our portfolios? And so forth. So
great. And what do you focus on? Because multi-asset is like everything, right? So what are your favorite things that you care about? What are your focus?
Yeah. So then I'll tend to be quite big picture. I'll focus on the macroeconomic environment of the markets around the world. And then we have teams of people who run the fixed income teams and the equity teams, picking the stocks and bonds that go in the portfolio. But I'll tend to think more big picture and think about, what is the economic backdrop, and how should we shift asset classes? Should we have more equities or more bonds this year, and so forth?
So we're in for a treat, right?
Yeah.
Let's see where this goes, right? But I got you guys in firstly to talk about the Fed, right? Because the Fed has been signaling for a while, or at least, okay, not say the Fed has been signaling, but the analyst community have been talking about it since the start of the year. Right, everybody tell me it's gonna cut. It's like, where is it coming? And finally, it came, right? And now there's an immediate discussion of the next cut. But what's going on, right? So kind of give a sense for our audience, retail individuals. They're relatively sophisticated. They get a general sense of how these things work. Why cut now? What did Powell say? All those kind of things. Maybe just kind of lay the ground for us.
If I could just chime in, firstly, how we look at interest rates, the banks are closely correlated with how the interest rates move. So anytime where we see interest rate cuts, the first question you might ask, are the banks' interest margins just going to come down? And I would say that it's just one picture and one aspect of the banks. Yes, the question of interest margins, but we also have to think that when interest rates are cut, are loan growth coming back? Now that brings back the topic of bottom line, the profits. Essentially when you have lower margins, but if your loan growth comes back, your profits might not be heavily impacted. Now we have also another aspect, what we call the fee income, right? Lots of your credit cards, your wealth management fees. Now all these are stickier income where it doesn't incur capital for banks. So it's definitely a sweet spot for banks usually. especially when interest rates are cut, you also want to see banks trying to beef up their efforts on this front, bring in more fee income. You can see, at least for our Singapore banks, since we're in Singapore here, you can see the banks have actually been beefing up their credit card books. Of course, UOB being one of the key player among the
The
peers.
ladies' card, right?
Yeah.
It's top of the list. Yes.
I still love the 365 card.
Yeah.
But essentially, it is points to the bank's business model because they are preparing for interest rate cuts and they're actually leveraging on different profit drivers to cushion their profits momentum as we potentially price in further interest rate cuts. Now, I think that's something to watch. But of course, there are different aspects as we look into interest rate cuts. We also look into then what happens to the bonds issued by the banks when interest rates are cut. And if I may just take a step back, I mentioned about Singapore banks earlier. I look into entire ASEAN banks. The ASEAN economy has been pretty resilient despite the macro headwinds that we see, geopolitical risks that we've seen. So looking at major ASEAN banks' dollar bonds, we actually expect the bond spreads to remain range-bound towards the end of the year, even when further interest rates cut could or could not happen. That is only because at this current tight spreads, we do actually see very limited room for substantial spreads tightening because the spreads are just really tight. And if I'll just give you the context, as of today's date, I think the option adjusted spread on an average basis for the ASEAN banks' dollar bonds, they are trading materially tighter than the 5-year historical average for the banking sector, as well as the index Bloomberg EM Asia Dollar Credit Return Index. And why so, you might just ask, and only because both of the major lenders, the big lenders in this region, they have very good resilient credit as well as positive bond technicals. What we mean by that, the refinancing needs are pretty modest going into 2025, and all this positive have been priced into their bonds, which leaves very little room for material tightening.
Okay, so in layman terms, that means bond yields are going to hold stable.
In
Right.
layman terms, if I would just put it, I would just say bond spreads are really tight. Now, I think as we talk about relative value for the ASEAN banks financial sector, I would say it's tough.
Tony, tell me, what is your take on the interest rates and all that stuff?
Okay, so I look at things, big picture from an economics point of view. If you would have asked me any time in the last couple of weeks, I would have been overly fixated. The cut, if it was going to be 50 basis points or 25 basis points and, what the signals were. But really, I think there's a much bigger picture story here that I think this is a nice opportunity to talk to you about. And I would say that actually, I can imagine like listeners hearing the news, the Fed cuts interest rates. Does it sound that much different than the ECB cut interest rates or the Bank of England, whatever? But actually, this is a really big deal and it's really good news. And I think if you took like a step back and just look at the macroeconomic backdrop and what this implies, there's like really several layers of it that are really very positive. And so the way I would break it down would be that, well, one, it's not only just the Fed's announced an interest rate cut. This is a start of a whole new cycle. And the level of rate cuts that we're probably going to get over the next year is very substantial. It's probably around 2 full percentage points lower than what we have now. And US rates are so important, it's going to ripple through the whole world and lower rates everywhere.
So you believe that it will be about 200 basis points, 2% rate cuts for the next year to come?
I do, but and there's a whole
Of course,
dialogue I would get
we're not
into,
saying
and
that-
I have like a view on exactly where they're going. It differs from the market view, and I can get into that discussion. But before I do, I'd say actually I find this is a nice opportunity because that's the conversation I get bogged into almost every day. This view of where I think they're going, what's priced into the markets, and so forth. But I think even more interesting is if you take a step back from it all, what I think, investors should see is that, we've started a whole new cycle. That's good. It's not just, one announcement that we're getting this time. Secondly, what it signifies that we've come so far. We had this big inflation problem. And this is really a sign of victory that the central bankers around the world are very confident that the inflation problem is behind us. And so that's like a second level of good news. The other level, it's pretty amazing that we were able to fight this cycle and this amount of inflation without creating a recession. So really the global expansion's continued. We survived all the interest rate hikes. And, back in 2023, if you polled economists, I think it was something like 70% of the world's economists thought the global economy wouldn't be able to handle it, would have a recession. And so here we are at the end of it. We've survived it. We have a continued expansion. And now we're about to start a rate cut cycle. So there's like many levels of this that I really think if you step back, it's good news. And then I even have a bigger picture one thinking over like multi-decade view, why this is actually very significant.
Help me understand a little bit. This 2% cut that you're hypothesizing, right? So this is not the position of the bank, right? Just to be clear.
And just be clear, so I work in the asset management side, which is a subsidiary of the bank, and the bank has an economics team.
Can you share with us a little bit more? You believe that 2%, right? So like, where's this number, coming from?
Just to put numbers on it. So in that rate hiking cycle, the Fed raised interest rates all the way from something close to zero, all the way up to what they call the targeted range between 5.25% to 5.5%. And so that's where they've been. And, this has been a rate hiking cycle that's lasted 2.5 years. And so now they're starting a cutting cycle. And what the Fed has said is they want to get to a more neutral rate. This is a tricky concept because if you ask economists around the world, what is the neutral rate, what it should be, you're going to get many different answers. And the Fed themselves are not being specific on it. So it is a bit of a guessing game. Where is this neutral rate? Our view is that it's somewhere close to 3.25, 3.5%. And so if you're going from 5.5, we think you're roughly going to around 3.5. So that's around 2 percentage points worth of cut. Just to add one more point, the market is probably expecting even more. The market is thinking the neutral rate's something closer to like 2.75. So if you think what I sounds good, actually the market's even pricing more and thinking it's even go lower.
And Bloomberg pretty much have all these data, right? Like what the market thinks of, potentially where's the neutral rate. Is there something there for us?
I think definitely within Bloomberg, economists have their own views as well. So by no means it's my space, but our in-house views, we have talked about where the rates are likely to be at, where we have our extensive team talking across the US to everything. So clients of Terminal can actually view that.
Okay, you get the terminal. Okay. So about 3 point something to 2 point something, that's kind of the space that everyone is thinking of, right? So why is it 3.25? Why is that the neutral rate? And what does that neutrality mean within your framework of thought?
So conceptually, the neutral rate is what is the rate of interest that is just sort of neutral for the economy, does not create overheating, does not create inflation, and doesn't slow things down, doesn't create deflation. And over an economic cycle, the central bank may feel like they have an inflation problem and they got to be on inflation fighting mode, and therefore they'll be above the neutral rate, pushing inflation down. So now they feel like, okay, we've been successful. We want to go to the neutral rate. The trouble is nobody knows what it is. The Fed themselves, is pretty much all they've said is that they're going to keep cutting rates and they're going to see how the economy responds to these interest rates. Another data point to be aware of is that for the last 10 years, the Fed has thought that that neutral rate is about 2.5%. So that's why the market is sort of pricing at, if they're going to go the neutral rate, maybe that is close to 2.5%. And I think there's a good percentage of economists around the world believe that the neutral rate has risen since post-financial GFC crisis in 2008, that there was this period of 0% interest rates. It does look like the global economies are able to operate at a higher level of interest, and therefore it's probably something higher than that 2.5.
Fair. I think a lot of the asset managers, around, whether the REIT managers that we talk to a lot or some of the stock people, they're all saying like they're expecting interest rates to be much higher than before this hiking cycle, and it was probably stay a lot longer. Right? So maybe that's kind of like the neutral rate that everyone is looking at. But one discussion out there that's happening, right, is that there is no visible recession that is happening, right? Will interest rates actually come down this much in such a short period of time? You know what I mean? Like it could probably like step down, slowly, but is it really going to come down significantly and quickly?
The first point I'd make is that already we've survived so much. We've survived 2.5 years of high interest rates. We didn't get a recession, and now we're getting the rate cuts. And the rate cuts are going to help a lot of industries. I think Rena was talking about several industries that are going to be benefiting. Just, I guess, the man on the street, you're going to feel a lot better on so many different levels, from your property to starting a new business, et cetera. So meaning if we haven't gone to recession yet, it's only going to get better from here. That being said, there's maybe a little bit of a complication in that things had looked like they're slowing down. For the most part, the last year or so, the global economy has been surprisingly resilient. But in recent months, we've started to see some signs of weakness.
Firing.
That's right. Yeah. I think the U.S. labor market and some of the data around other developed markets, they've started to look a bit weaker. So I think behind your question is, have we already started that slippery path down? Or is the cuts, are they going to come in time? But for the most part, I think it's fair to say there's been some slowing, but the slowing hasn't been that dramatic. And mostly as I look at it, I'm pretty relieved that we survived this much and now we're going to get rate cuts and things should get better from here.
So we got a soft landing.
Yeah,
because that was the talk of the town for a while, right?
I think,
Yeah. I want to kind of understand a little bit better around this interest rate thing, right? Because for a lot of retail, when we look at interest rates, like the ECB, the Fed, Bank of Japan, they're quite lockstep. Right? Everybody is kind of like, they raise together, they cut together, right? Pretty much they're quite lockstep. But this round, you start to see everybody having a little bit of a difference, right? They're not as like tight together. Is it something that we should read into? Is there some thoughts here? Maybe you can, enlighten us a little bit.
Yeah, probably you could share on the more sectorial front when I look at it. Like you mentioned, how should like a retail person look at it when, let's say, interest rates are cut?
Because there's so much information right, all the time. Yeah.
Exactly. And I'll say, be it you're an individual or even a corporate, which I may just touch on further. Now, as a retail person, you borrow, right? You can choose to actually, do you want to postpone your financing or not? And one of the key loan product that we are looking into Singapore is housing loans. And we know that other than resale, most of the, let's say, the new launches are on floating rate loans. And we are seeing that actually, even for the fixed rate loans offered by the Singapore banks, they have come down quite substantially. And that's because the Singapore banks have actually, reduced in line with the anticipation of lower interest rates. Now, is that slightly better for homeowners? Yes, just because lower interest rate, lower borrowing costs for us. But we take a step back. I think just now you mentioned about, are there any signs of weakness? And I think these are some key areas as we look into banks, where I look into the sector almost day in, day out. Couple of areas. Now, firstly, in terms of retail lending, whether stress will actually rise or not, it heavily ties to the employment conditions that we have in the economy. So far, I know things are not blowing up yet. Correct me if I'm wrong, Tony, but because, employment is still holding up. Let's see, for Singapore, it's pretty resilient. Yes, we have some layoffs. Very unfortunate
but it doesn't
to
feel
hear.
like the whole street is down, right?
Yes, right. Which is still holding up. A lot of the employment is still there, which allows people to actually repay their debt despite the purchasing power has actually weakened, right? So that helps
but
to buffer
everybody
a
have
bit.
to go to JB to buy diapers and milk powder and all to kind of manage this.
Yeah. And I think move on to being a corporate, right? Corporate, you have then to think about whether you want to refinance at this still elevated interest rates or take a step further and postpone it where rates are coming down further eventually. Now, these are some of the key considerations. And even as we look into banks have their own considerations as well, where interest rates are cut from the profitability angle to liquidity and capital management, which is something that I'm actually very keen to talk about. Because if you look across our ASEAN region, a lot of the major ASEAN banks, like your Singapore, your Thailand, Indonesia, a lot of the big banks here, they are well capitalized, so that's a good problem, but they are having a very costly capital structure. And what I mean by that is a lot of the major banks in this region here, they actually rely mostly on very costly core capital. In layman terms, it's called core capital. When we look into the banking terms, it's what we commonly coin as the common equity tier 1 capital. And they rely heavily on that to actually meet capital requirements. That is actually costly. Now, when interest rate comes down, some of these major banks could actually tap on the investor demand for you to really optimize their capital structure by issuing subordinated debt. You might ask, what is subordinated debt? What we call the additional tier 1 bonds, the AT1s, that actually rack up the headlines when Credit Suisse AT1 was actually created such a big saga.
Crazy.
Yeah. Short-term market as well, rare precedent, as well as what we call tier 2s, T2 bonds. Now, tier 2 bonds are actually ranked senior to AT1 bonds in the bank's capital structure. And because of all this capital debt issuances, banks can actually leverage on them when interest rates are cut to optimize their costly capital structure that's heavily banked on the core capital, substitute all this core capital to actually raise shareholder holdings.
So that helps to manage
dividends.
margins, right? Essentially.
Yeah.
Okay. Fair. Maybe, Tony, just on that, like central bank rates, or am I overreading into this, right? Like, because not all the central banks are aligned, right? So what's going on there?
Yeah, so I think the global economic cycle is frequently very closely aligned, especially after like severe shock. You have a global financial crisis, the whole world is suffering, and And the upward rebound afterwards is kind of simultaneous. But I think it's also not so uncommon that different regions have slightly different cycles. And I think you're seeing that. I think around the world, the US cycle was probably the most robust on the upside. And therefore, it's among the last to really start cutting rates. Europe, which was seeing slower growth, they were able to cut rates a while ago. So I think you're right. The rate cycles are slightly different, but they're kind of similar. And I wouldn't read anything into it other than the world isn't completely synchronized in its
Okay.
growth. And actually, I think I like investing in a world where not every economic cycle is completely aligned.
So on that note of Switzerland, right, which is a big thing, like two of the biggest Swiss banks merged, right? Merge is a very nice way of putting it, right? One forcefully bought over the other, and wasn't even like they wanted it, right? The governments came in and asked the other to buy, right? So like, what is going on there, right? Is there something to read into? Is it like the weakness in the European, financial banking sector, or is it one-off? It's hard to call it a one-off because it's like, multiple US banks and then this huge Swiss one. So what's going on there?
And I think one important takeaway from all this crisis is, I think the recognition of whether the loss absorption capacity for additional tier 1 bond is very important, because AT1 bonds back then was introduced by Basel to really beef up a bank's capital resilience, right? Improve their loss absorption during times of crisis. With this whole, with this saga that we've seen for a Credit Suisse,
It got written off.
yeah, it brings back to the question, can we still trust AT1s as a tool that could really bail out banks in times of crisis? And you have recently seen that Australian regulator APRA had decided to phase out AT1s bonds as a instrument. And the repercussion of that, the question is, will other major economies and financial sectors follow them? Now, I think we have to take a step back and firstly understand why is APRA doing that. At least if you take a step back, if you see the case for APRA, there were a lot of retail investors who were actually investing AT1s. Now that actually poses a problem if should you want to use AT1s to build a bank and you have a lot of retail investors holding that. So that might be some complexity right there. Now, contrast that with Singapore, where actually our additional tier 1 bonds, the AT1s, are only offered in the wholesale market. What do I mean by that? They're only offered to the
That means
institution.
you don't get it lah. You don't get it. You get a packaged one that someone will buy and package sell you in a unit, right?
Yeah, because they're only offered to super high, what we call the accredited investors, wholesale market institutional investors. So that limits the risk of retail investors holding. So actually, that's why we think that the Singapore regulator, which is actually follow the Basel rules, the Basel committee, they are unlikely to wipe out AT1 as an instrument for banks to improve their loss absorption capacity. So I think it's quite different. We kind of need to know the nuances, but I would say going forward, AT1 as a capital tool is likely to be evolving and continuous to grow depending on different jurisdictions.
Fair. Because retail tend to have a little bit more like volatility in the way they move money around, right? Whereas Insti has a mandate, just put it there, complete the mandate, full stop, right? So it's a very different thought process, and the way bank runs and all that, that's also a very different mechanics altogether, right? So what's your take? Like these so many banks in the West gonna so many things, right? And the Swiss thing.
I like about looking forward is I do think that past 10-year period where interest rates were near zero, that was really hollowing out the banks, and it was particularly bad in Europe. And then interest rates went up, and that's generally good for the banks, but it's also a little complicated in that the slope of the yield curve, where the difference between short-term rates and long-term rates, it works much better for the banks when you have an upward sloping yield curve. And for the last year or two, we've had an inverted negative yield curve. And therefore, there's been a number of things that have been negative. But this environment in the coming years where we have rates that are not too low, not too high, an upward sloping yield curve, that's a good backdrop for banks.
Mm-hmm.
And therefore, I think all those headwinds they had been facing, I think the outlook looks a lot more reasonable now.
Fair. I understand what's going on, right? Essentially, if the rates are too high, nobody's borrowing, the velocity comes down, your net income is also not as great, right? So now everybody's trying to find a new balance, bring the rates down, hoping that more people will borrow, and then the machine kind of carries on, right? So that's for banking, right? But moving away from the banks, with the backdrop of the Fed coming down, like what are some other interesting sectors, that's in your purview? Or other interesting tools that you think we can educate our audience a little bit about this is how it works?
Yeah, so maybe just a couple to throw. So I think other sort of beneficiaries that we're watching is is how will the consumer react? And then the other big one is property. And the property story, I mean, it's important. I think many people would have heard that commercial real estate around the world was really under a lot of stress. Things were looking bleak. And, when we were investing in markets, that was a major thing we were considering. Is that going to unravel to the point where it's going to start to affect global investments? But these interest rate cuts, boy, it's really helpful now, because not only has the commercial real estate survived this cycle, now you have interest rates coming down, and you're also taking away the fear that they might go up more. And there's still some weaknesses, but suddenly, everyone's credit worthiness looks a little bit better when your interest payments aren't necessarily going to be as high. And so now those risks and things like commercial real estate look a little less risky. And then just, for the man on the street, obviously interest rates affects many ways, but the home mortgages are a big one. And that's been a big drain on disposable income of people around the world. And that's going to start to normalize. And there's a lot of levels, and this can have ripple effects throughout the economy in many sectors.
Yeah, but can I push you a little bit on the commercial REIT? Like, there are some commercial REITs that are listed here that has a lot of exposure in the US, and they didn't do very well, right? Over the past cycle. Of course, interest rates move up, everybody kena, and these people probably have an outsized impact. But the fundamental question is, like, is there still demand for commercial property, right? Like, or has that ship sailed, because the longer the interest rate environment sticks at a particular interest rate, the market normalizes it, right? The mean reversion, rental reversion, everything kind of comes in. And if you cannot compete, you're out, right? You get priced out of the market. So does that mean that the fundamentals have shifted? Like, commercial property is just not as hot anymore. Even if interest rates come down, it will help the managers manage the kind of cost of debt, but fundamentally it is still not bouncing back. Any thoughts on that?
I think commercial real estate risk is one of the key risks that we are watching for global banking sector since the start of this year. And of course, the cut in interest rates will help, but it also brings back to the question, what's happening that we see in the US offices, work from home situation. Is that going to normalize anytime soon?
Everyone wants to work in Nevada and Arizona. Nobody wants to stay in California anymore.
And I think that boils down when there's a fundamental shift in the way of mindsets and the lifestyle. I think that's harder to change. Of course, on one hand, we have the positivity boost from the lower interest rates, but I think that aspect of the returning back to office, the willingness and the sustainability of that happening is also a question, and it remains to be watched, I feel. But of course, that will help to, with lower interest rates, that may help to lower a bit for the commercial real estate risk that we see for the banks. But on real estate risk, it's not all the same for the banks across the whole global economies.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Back on that topic of will commercial real estate actually bounce back, or is it just a better capital management situation for some of these managers? What is your position on it?
Yeah, so also commercial real estate, it should be said, if you're investing in a commercial real estate REIT, there's actually much more than just office. I think office makes up around 20% of commercial real estate, and that's the weak point. That's the hollowing out effect. So the fact is, interest rates changing helps, and it's not like the fundamentals completely change overnight, but if you survived the past year, then the next year is going to get easier than it was the next year. The other effect I would keep an eye on is part of this work from home effect. The rehiring of all these employees after COVID really put the worker in a position of strength. Wage growth has been higher in the last 2 years than we've seen in 20 years. The workers have been able to demand more wages, and the employers have been so desperate to get their workers back. They've been giving raises. And when the workers say, I want to work 3 days from home, they say, okay, I just need a worker.
Is that still the case now?
Because that's less the case. Exactly. Yeah, okay. So the level of new jobs has slowed down.
Yeah.
And, as economists, we track the quit rates. The quit rates are a great signal, because if people quitting their jobs, that means they're super confident, they got something else to do, but the quit rates is going down. So the worker's a little less confident that he has multiple choices now. And so that'll probably lead to a trend where they'll give the employers who are asking people to come back a little bit more leverage, like come back or else. And whereas the last year, if it was take it or leave it, then the employee had too many options.
Okay.
So I do think that dynamic's changing too. And with time, even the office sector can maybe stabilize a bit. But you're right to point out that it's not
a
like
big
that's going to,
maybe, right?
that's right. It's going to take more time.
But if that's your thesis, then that's your thesis, right? But that's a big maybe. Okay, great. So pushing a little bit more about the consumer, right? Because I think we're kind of like at the crossroads of like consumers, and of course the big ticket is with property. It forms a very big part of consumers spending, right? But what about the other aspects? Other aspects of consumer spending, or how do you foresee some of these other sectors develop? Could be in the bond market, could be in the stock market, or even in FX, right? I'm kind of open for that. Just want to see what do you usually cover and what do you think is interesting, that we can explore within the consumer space.
And I think that's a good question, right? Because in overseas, when you talk about United States banks, people were just worried about the credit card write-offs. Contrast that with what we have in Singapore banks, we continue to see the credit cards book actually being a bright spot for the Singapore banks, right? We have a lot of large-scale events in Singapore lately, various types of concert. I haven't been to one myself. As business travel resumes, leisure travel, all this kind of events, people are still willing to spend, at least from what I see in terms of those in
So
Singapore.
that is strong.
Yeah, I think for Singapore banks, the credit card books are really very strong. And I think partly that's also the reason why we see an enlarged credit card by UOB after the purchase of their CD acquisition for the unsecured retail book, because they're actually planning ahead. And I would say that is going the right choice, because when interest rates are cut, we need the fee income as a bank. And they are actually moving to that, which doesn't consume capital. It's a kind of a double win for the banks as well.
Okay, not sponsored today. Just to be clear, this is Rena's position. That was interesting. Yeah. That means from the credit card numbers, it shows that consumers are still spending healthily.
Yes, because the charge-off are not even high. I would say it's still below the 10-year average. Of course, it does creep up a little bit. I would say, as given that back then we have such high interest rate and we still are in a high interest rate environment, but with a slight normalization, I would say it's still pretty healthy.
Yeah. Because there's always a variance, right?
Yeah.
As long as you keep within the variance band, it's okay. But just kind of go a little bit in that, right? Because the Chinese market at this point in time, there's a lot of talk around like a search for value, like the consumer standpoint, right? I've interviewed a few people and they all say, oh yeah, the Chinese market, people are looking for value, people are kind of like moving away from luxury, or maybe they will find like different types of luxury. Is that true across the board in other places around the world, or is there any signs on that consumer spend? So in a sense, like people don't reduce their spending, but they're changing their spending composite. Is there something there?
I think that trend brings back to a bigger question, what's the consumer confidence we have here? If you're confident about, firstly, your own income, your own employment, I'm happy to spend as an individual. But if you're worried about the economy, more headwinds to come, you don't know what to expect, I might just be a bit more cautious, depending what kind of person you are. And I dial back my spending and probably look for what you mentioned about value, right? Because value means different things to people. But I think essentially that really makes a part of what we talk about consumer lending. As we look to all these consumers, what kind of consumers are you lending to? Are they of sufficient, I would say, income conditions that they'll be healthy? You don't expect much delinquencies in your portfolio even when you lend to them over, I would say, a longer duration, right? Because for consumers, they actually need more seasoning into their vintage books. So it's quite different.
Okay, so there's no conclusive data on whether consumer habits are changing, but it just looks like it's still strong, at least in Singapore and in this part of the world. Okay, fair. Any thoughts there?
Yeah, so I do think different parts of the world will have slightly different dynamics. And so, the big dynamic is the interest expense that is mostly a burden on families around the world is that home mortgage or maybe an auto, secondly. The way interest rates are handled around the world can be different, right? So in the US, everybody has 30-year fixed mortgages. And so what happened in that market, they didn't actually have to pay higher interest on their mortgage loans. They paid the same. But what happened was everybody became trapped in the house they had 2 years ago. Nobody could move because your 2% interest rate mortgage would turn into a 7 or 8% interest rate mortgage. And nobody wanted that. So everyone just stayed where they were. So in that type of market, well, one, the auto sector probably benefits from lower rates, and that's going to help there. But just in general, it'll allow more flexibility, labor markets, more people easy to move, more ability to sell house if you want to. And so it is a powerful economic force, but it's a little different than markets like in Asia, where you tend to have your effect on your mortgage rate being a bit more floating.
Why is our mortgage rate so floating?
It's largely due with in the US, they have really stable long-term bond markets that allows the banks to price a 30-year mortgage much more easily than in markets in Asia,
So
where
they
you don't
sell a
have
very
these.
long fixed mortgage,
Yeah.
but then they will package it and release it back into the market, and then they de-risk from there.
That's correct.
Okay,
So that
okay.
the banks can manage it without
Yeah,
taking
as compared
excessive
to
risk.
here, right? Where
Whereas
it's all on your
here,
books.
yeah, the banks would
Okay.
have to take
Okay.
more interest
Okay,
rate
that's a
risk.
different discussion. But yes, please continue. Yeah.
But in places like Singapore, I imagine many of your listeners
3
would
years.
know, that over the last few years, a lot of
Yeah.
mortgages have been tied to SORA, the overnight rates. And as they went up, people had to pay a lot more. And if, I don't know, they had a $2,000 mortgage, it went to $4,000,
Exactly.
right? And therefore, that takes a big chunk of your disposable income. And that'll go down, probably not to 2, but at least probably halfway there. That creates a big consumer effect where everyone will have, it's like getting a big pay raise. It's like we all have a little bit more disposable income.
Okay.
And so in markets in Asia, then I think you can see more dynamic consumer discretionary sector benefits. So companies that sell to consumers are probably going to become a little bit more vibrant.
Interesting. Okay, so just to kind of wrap up there a little bit, so the consumer discretionary bit of the game probably not as interesting in the US going forward, but a lot more interesting here because the interest rates adjust. There's a bit of a buffer, and people are not locked into a 30-year mortgage. Then they could kind of spend the extra. That's kind of what I'm hearing. Okay. Interesting. So more travel, more makan, more things, more of all this kind of stuff from a consumer standpoint. Okay, good. So I think that kind of lays a good ground on like what are the interesting things, tied to the Fed cut. Any other things you want to add in the Fed cut story?
Yeah, I got one more, and it's even more bigger picture that I rarely talk about, but I think about in the back of my mind. It's again towards how far we've come. And as an economist, something that I would sometimes tell friends is that, in the last decade, in that 2008 all the way up to COVID, one of the things I was really worried about as I looked at the global economies was that how could it be that interest rates were 0% for nearly a decade and central banks were trying to get interest rates and inflation back to more normal levels? They were printing money like crazy. They had interest rates at 0% for a decade, and they couldn't create inflation and they couldn't get the interest rate to normalize. And what scared me is that looked like Japan, right? I was like, oh, is the whole world turning Japanese, where you have decades of deflation and really sort of stagnant type growth levels? And, as a multi-asset investor, I think that's bad because like equities in Japan, over like a 25-year period, they did nothing. They gave you no return. And I'm like, that's a disaster if that's the backdrop we're slipping into. But so again, not only did we survive the interest rate hike cycle, but now we're normalizing it. And if I was to step back and say, I don't even think it's sinking into everyone what the world was like in the last decade and how things have normalized, and it's such a big deal. It would have been bad for the world to slip into a Japanese deflation. And so obviously rates going up was one counter to that, but we survived it and we're normalizing and getting through that whole cycle. And, I think we can all sort of breathe a sigh of relief if you think of that big picture scale.
Okay, fair. So we have kind of wrapped up this Fed cut thing. I'm going to kind of push into a space that we didn't prepare for. We only wanted to come into studio to talk about the Fed cut, but because in the opening you were talking about, some of this war thing that is happening in the Middle East, right? And it's front and center on the news cycle. Sometimes I also wonder like what's going on, not from the actual war, but how is it going to affect broader economy, broader, markets, oil, gold, all these other things, which, since you're here with me, so expound on that a little bit. Like, what is the financial world's view of the situation in the Middle East now?
As a global multi-asset investor, geopolitical risks are something that are complicated and that we spend a lot of time thinking about and trying to understand what are the risks to our investments.
And George Yeo, our ex-foreign minister, famously said you cannot write off geopolitical risk anymore, right? And he was on one of your events, right?
That's correct. Yeah.
So yes, please continue.
Obviously, the military conflicts around the world in the Ukraine, the Middle East are among the biggest geopolitical risks. Now, as a multi-asset investor, we do look at all like the prior wars and conflicts in Iraq and Afghanistan and so forth. And for the most part, the takeaway is that they tend not to have an overly influential effect on portfolios. Even those prior wars, there were maybe some volatility for a quarter or so, but really given some time, they rarely end up affecting your long-term trends and your returns. And it's more of a short-term issue on how to manage. That being said, the conflicts around the world, they feel bigger than we've seen in a long time.
Does feel like it's getting bigger.
And I guess the Middle East conflict in particular, that's a sensitive area to the world's energy, and it's been relatively stable for the last decade. And if this spirals in a way where it's a broader regional war that brings in Iran and other countries, then that's a scenario that feels like, even though most of these conflicts historically haven't really affected markets, that feels like it's getting big enough that we worry could start to affect markets.
So maybe we push that a little bit to say like the easy ones is like oil prices, right? Like everyone, because that's like the place where pretty much 70% of the world's oil pretty much come from there, or like 60-70%. So like, how does this work beyond oil prices? Like maybe just kind of give us a little bit of, we're not hypothesizing, right? We're just trying to understand like how it could potentially ravel from your professional point of view if this escalates.
I think oil prices is a big transmission mechanism. And what happens then is it starts to infect inflationary view around the world, and this whole rate cycle that we're just suddenly so positive about, that starts to unravel. That the case, maybe you can't start cutting rates like this if inflation is picking up again, and it can affect growth around the world because everyone's uncertain and maybe energy is too short. And then you can have a terrible combination where growth is too soft because you don't have enough energy to run all your factories around the world, but you have inflationary problems, and then central banks can't cut rates because they're fighting the inflation problem, but you have weak growth and they're stuck in the middle. So there are scenarios where you start to destabilize a region and you bring in energy problems and pricing inflation problems. That can be bad news. And so I don't mean to be overly alarmist. As a matter of fact, we're putting like hedges on, but we're not changing our positions in our portfolios. But I think as an investor, that would be the scenarios you have to think about. What's the chances of something like that happening, and how would it affect your markets?
Fair. So if, let's say, it caused a runaway inflation in the US, the central banks would then move up the interest rate, or that's the prevailing logic, and then it'll affect my mortgage again.
That's
So,
right. Yeah.
so 2,000 become 4,000, now become 8,000, right? Oh my God, that'll be horrible. Okay. So do you have some thoughts around
Yeah,
this?
probably if I could chime in on this second order impact that might be potentially be watching for the banks is, with the potential geopolitical risk and everything, is the rates and currency volatility. Now it brings back to the point how well the banks are actually managing the currency exposure as well as the rate exposure, right? I think earlier at the start of this year, we have seen about the massive unrealized losses sitting in some of the regional banks in the United States. Now, that also brings back to the question, how well are the banks going to manage it? Should there be rates volatility and currency volatility? At least what we've seen for the most of the major ASEAN banks in this region following the Asian financial crisis in 1997, they've actually beefed up their hedging for currency risk, as well as regulators have actually implement measures to cap the currency exposures for the banks, with regulations with what we call the net open position. Essentially, is to really limit how much of the currency exposure is unhedged as a percentage of the bank's capital. So I think that are some things to watch out for the banks as we go into such a potential scenario.
Any thoughts on that front?
No, other than I think it's right. The secondary effects start to get complicated. I was thinking from your credit point of view, the amount of bonds that are being bought by the region of Middle Eastern bonds, it's big parts of portfolios. And then suddenly everyone's going to be doing their analysis. What percentage of your portfolio? And you have these ripple secondary effects once a region is really under a lot of stress.
Mhm.
So again, it's not our base case, but it's one of those risks you have to think through.
It's more than zero, right? Like from a probability standpoint of this happening. And every day, maybe not every day, but every month, it looks like it's increasingly possible. So we're not trying to be alarmist, I agree, but it's just trying to understand what's going on and how it could potentially unravel, because it's all just a lot of news, it's really noisy. Just want to get a more organized view on this. So when you talk about like you guys putting on some hedges already, like what are those things? How are we hedging geopolitical risks from that point of view?
This sounds like overly complicated, but not to make it too complicated. But so we would have a view that's positive of the world, right? This looks like a world where we have continued expansion and interest rate cuts at the same time. And if you look at historical periods, that's been a dynamite combination. I want to be invested in these markets and I don't want to give up the upside. So what's going on in the Middle East does worry me. So there's different ways you can put on hedges. Like one would be shorting futures of the markets. But when you do that, you're pretty much giving up your upside. It's kind of like selling all your positions. And I don't want to do that because I'm positive on the way things will go if these wars don't spiral out of control. So we put on the types of hedges that give us what they call convexity, a little bit more protection on the downside without giving up the upside. And it's kind of like more option-based type hedges to protect portfolios. And so I think in different environments, we'll do different types of hedges. But the ones we're looking for now is trying to get some downside protection without giving up all your upside, because the upside still is positive if we get through this.
Okay, so speaking to the layman,
Yeah.
so I want to go down there a little bit to try to kind of open that up a little bit. Does it mean that you're kind of like buying options, some of these major assets that you're playing around with, so you pay a premium to cover the downside? Is that kind of the situation?
Yeah, I'd say that'd be broadly it.
Yeah.
Now, the trouble with that is those premiums can be expensive. So then we try to find ways to reduce that and offset that by selling some other options. So we collect some premium, sell some premium, and try to get the protection we need.
Okay. So you sell the positions that you think it's not so probable, but carries a decent premium, and then you kind of like manage that.
That's right.
There's a bit of trunching on that side of things.
And that gives us some insurance cost. We'll pay a premium for that insurance, but we can try to limit how expensive that premium is.
Okay. I mean, that's a great layman point of view, sharing with people, because I think these days more and more retail investors are getting easy access to some of these products and tools. And some of the marketing messages are all over the place, right? So my point of view is that all over the place. They are useful tools. Many professionals have been using it forever. But when we translate it to the retail, like we do need to kind of expand on like, how does this really work, right? And that's a whole podcast on its own. But thanks for kind of laying that a little bit and not being afraid to go there, right? Because some people will just dance around me and just say something else. I was, oh yeah. But thank you, right? So that's great. I think we've shared quite a bit of stuff, right? We've gone from Fed cut, Swiss bank, it's like global war, which are all the big things, the big themes that are kind of happening. Of course, the big back theme is still like Fed rate cuts, economy looks decent, looks like it can come back. We kind of got a soft landing. I know soft landing is a marketing term, right? So we have kind of have that whole thing, but with some pockets of other potential happenings. In closing, do you have any other things you want to share with our audience? So that they become more astute, understanding the global markets or what's going on.
Just following your mention about the Swiss crisis, I would just say, and I remind the investors, when you invest into bonds of any particular company, I think it's key to really read the bond documents, especially for riskier debt when it looks into the bank's capital debt per se, your callable debt like your AT1s. I think it's best to really read the terms and conditions, your core dates, when's the first core date and everything, or your write down triggers and everything. I think that is really key to watch. Yeah.
That's a whole podcast on its own. Yes. And I was really surprised that the Swiss government just said out, right? And they just wipe out the whole thing. I was like, wow, you could do that. And we see the impact, right? The market is punishing the franc and everything, right? So, but that's a different discussion. Okay, yes. Any last things to add?
It occurs to me that I never really quite made the point that I think I see frequently mentioned that interest rate cuts can be associated with bad markets. And just to be clear, I've seen charts like that out. And I think the answer on this is really simple. Frequently, interest rate cuts come because your economy is going into recession. And therefore, if you look at the performance after interest rate cuts, there's a lot of periods in history where the market performance is very negative. But there are periods in history where interest rate cuts have come when you're in the midst of an expansion, and the markets always perform well during those periods. And hence, I think it's just, if you want to ask which direction the markets are going on, we just need to be reassured that we're not going to recession. If not, then this is a pretty positive backdrop for investing in the next year.
Okay. If our audience would like to connect with you, where is a good place to connect? Probably LinkedIn. Is that a great place?
For me, I would say definitely if you're a Bloomberg terminal client, please actually IB me. So BI research is really extensive, but yeah, ping me, if any questions are on my financial space. Yeah.
Okay, great. And yourself?
LinkedIn would be great.
LinkedIn is great. Okay. So thank you. We'll put the link below. And thank you for your time.
Thank you. Thank you for having us.
We'll see you next episode. We're not trying to be alarmist, just to be clear. It is what it is. I hope to put this episode together to kind of give everybody some thoughts to manage what's going on. Because I know sometimes there's all sorts of news. It gets a little bit all over the place. I hope today's episode is helpful. Okay, with that, thank you. See you all. Bye.